So, I started a video series that I like to call Baby Adulting. What it talks about is just those very first things that you need to do as you're learning about being an adult. Like all the things that your parents used to do, all the things that you've never had to do before because you haven't been old enough, all the things that you just have questions about and no one really can answer them. And I came up with this series based on a list of questions that my own 5 kids have asked me between the ages of about, 18 or 19 when they moved out of the house, all the way up to age 25, 26, 27. We're gonna go over things like buying your first house, how to sign up for a 401k plan, what is investing, and how do you even get started? Those sorts of questions I'm going to answer for you and hopefully give you some really good advice to kind of start out your journey so that you can end up being fearless. I am here today with Pam Wandry, who's Columbine Mortgage. Today, we're going to be talking about qualifying for your first mortgage. I have Dylan and Isabel Jones who are going to help us with questions that they had kind of going through this process and maybe some that come up for you. So, start with some of the questions you had. I'm going to let Pam take it as the expert on this.
Our first question, first and foremost, was like, where do we start? And what's the first thing we should start looking at and doing when we decide that we might want to buy a home?
The very first step I would say would be sitting down and taking a look at your finances and kind of looking at your budget. You want to get comfortable with your numbers, know what your income is, know what your outgoings are, like what are your monthly expenses that are like, the ones you have to pay, and then the ones that are like more expendable. Just have a feel for that and then whittle it down to what you think your payment would be that you would be comfortable with. And then that's when I would say you'd want to then talk to a mortgage professional. It can be super early in the process, just having somebody else kind of help you make sure that what you're looking at is correct. But that would be the very first step, is get those numbers kind of dialed into like what you think you'd be comfortable with for that monthly payment.
Should they start that like 6 months before they're thinking of buying a home, or is it like a year thing, or should they start it when they turn 15 and get their first job and open up their Roth?
The sooner the better, honestly. I don't think it's ever too early. If your goal is to own a home, talking to a mortgage professional and knowing how much you want to have to save, your budget would look like, what payments would look like, if you have any credit issues, if you have no credit, those are all things that the lender would be able to look at with you and help you at least get steps in place to make sure that when it is time to purchase, you're ready to go. So the sooner the better.
Pamela, is somebody like you, on the mortgage side, is that who we should be reaching out to first when we're looking at buying a new home? Like, who's on the team and like, how do we bring them in? Like, at what point should we start bringing people in?
Most people, when they think buying a home, they go to the real estate agent first. Until you know what your numbers are and what you actually qualify for, you could be looking at a home that either you're, you may be looking at a home smaller than what you could actually qualify for, or you could be looking at a home that's way more than you qualify for. And so that's really to talk to a mortgage professional first is ideal. So then you can get those numbers dialed in and okay, our max is this, our comfort level is this, and just know. So then when you're looking at homes, you're not wasting time looking at a home that you can't afford or, looking at homes that are not quite what you're hoping for and not even understand that you actually could purchase the home that you want. So it makes the big difference to talk to the lender first, and then that team of the lender and the agent working together so that then the agent actually does know what is in your price range and can show you homes that fit your budget.
How do we know what our price range is, or like how big we could go with the home, or how do we know?
The debt to income ratio is what a lender is looking at when they're trying to determine what you qualify for. You can kind of zero in on that with a very quick conversation with a lender, of a high level conversation, just kind of what your income is, what are your expenses, and then they can kind of figure out from there based on where rates are today of what you would qualify for. Now, qualifying for something versus what you're comfortable with are two different things. Yeah, you may qualify for the $700,000 home, but that payment is 50% of your income. Like, do you really want to do that? Your comfort level may be less than that. So it's easiest just to call a lending professional and have them just do a high level conversation with you. And then they can give you a pretty good idea of what that would be.
And Pam, you said debt to income. So do they take into account like the student loan debts? Because I know a lot of our younger adults have student loan debt. Do they look at all the debt?
So the big ones that they'll look at, if you have a car payment, they're going to look at that. If you have any student loans, even if they're in deferment, they will come up with some type of payment for that, depending on which loan product you're in. Eventually, you'll have to pay on those. So they factor that in. They look at credit card. They use the minimum payment that is due on your credit card. That's the amount that goes in factoring that. If you have any personal loans, that goes into the debt to income ratio. It doesn't typically happen or occur with first-time home buyers, but if you have any divorces or alimony or child support, those are also included in the debt to income ratio. Things like insurance, cell phone bills, things like that do not go into it.
When we were looking through some of these numbers, one of the things that was kind of confusing me was the mortgage insurance side of it. What is that part of it?
Mortgage insurance, most people think of insurance that they're paying for as something that's protecting them. But in this case, mortgage insurance is actually protecting the lender. It protects the lender in case the borrower defaults. And so on most loans, particularly conventional, if you put less than 20% down, you are required to have what's called mortgage insurance. And so that protects the lender since you're putting less down, you have less skin in the game. They're on the hook for more. That if you default, that they're able to recoup from their investment. A couple of good things about mortgage insurance, though, is one, it can be removed after your debt or your loan to value does dip below that 80% loan to value. You can have it removed. And then the second important thing is that it allows for home buyers to purchase a home before having to save that full 20% down. And the mortgage insurance factors are lot lower now than they used to be. So they're not as big payments as used to be. So it's not as much of a hindrance. So it's not a big scary thing. It's a tool that allows homeowners to get into a home. So it can be a good thing.
People talk about like timing the market. Is there any better time to buy? Should I be holding off until a certain point?
Timing the market is virtually impossible. People might wait for rates, but by the time you think you're at the lowest, they've already gone back up. Now, maybe waiting 6 months versus 3 years, you might have a reason to wait 6 months. But if you're looking and excited and ready to do it now, trying to time it for other reasons usually aren't as beneficial as people think they are in their mind.
They might have gotten a better interest rate on it if they waited, but the actual house price usually goes up in inverse to the interest rate a lot of times. So, yeah.
And we can always manage the interest rate. You can always refinance. If the rates drop enough, you can always, tick that down.
Another question that we had, what is pre-approval and pre-qualification and how do we get that done?
So people use those two terms interchangeably a lot, but think of them as the pre-approval is just a step further than the pre-qualification. A pre-qualification may be just a quick phone call. You tell them what you say your income is, you tell them what your debts are, and they say, this is what you would qualify for. Typically, when you want a lender letter, you need to go through the full pre-approval process. And that's when you're actually going to fill out the loan application. You're going to provide documentation, so your income and your assets, your bank statements, your driver's license, and have your credit run. And then if everything looks good, then you'll get that lender letter saying that you are pre-approved. And having that pre-approval is a much stronger offer than just saying I'm pre-qualified, because you haven't proven anything with the pre-qualification. Basically, I said that this, and this is what they said, kind of a thing.
So how does that work, Pam, with when they should go to the real estate person that shows them the houses? Do they want to have that whole pre-qualification process done before they go looking for houses?
Well, you definitely want to have that in place if you're serious about looking at homes and think you're potentially going to be making an offer. Most agents are going to want that lender letter anyways before they submit an offer. They can overlap a little bit, but generally it's best to get all the pre-qualification, pre-approval steps done before you're really serious about making or wanting to see home.
When you're talking about the process for like a standard loan, I had a little bit of a tough time understanding is like what the different types of loans are.
The ones that you hear the most about, the most common ones, are conventional loans. So if you hear the word Fannie Mae and Freddie Mac, those are the government agency-backed loans, conventional loans. And that's what majority of loans are written to in their guidelines. And then there's other government-backed loans like FHA, VA, USDA, another very broad category called non-qualified mortgage or non-QM. Most lenders start with trying to put you in the box of a conventional loan. You have normal income, those things, you typically go that way because that's what majority of loans are written to. If you're a veteran, obviously you can utilize a VA loan. FHA loans are typically used for clients who have low credit and not a very big down payment. That's a HUD-backed loan product. So once again, a government loan only requires 3.5% down, but it has guidelines that allow for those lower credit scores. Non-QM is for all the loans that don't fit in those boxes. If you have self-employed income, but have only, don't have enough tax returns, or you're buying an investment home, like there's a whole wider range of products for that. So that's if you don't fit one of the other boxes, then you go to the non-QM. So generally when you speak to somebody, the first thing they're going to look at is conventional. Your lender should be speaking to you and asking you questions like, you're first-time home buyers, how long do you plan to be in this house? Are you starting a family soon and think you're going to be moving in 3 years? Maybe it does make sense to do an ARM where we can get you in at a lower rate versus a fixed loan.
Does our credit score affect our ability to get a loan, any of those types of loans at all?
Credit is a big thing. And so that can either make it so you don't qualify or it can also impact your rate. That's another reason it's really important to talk to a lender the sooner you can. Unless you know your credit's in good standing, if you have any questions about your credit or have no credit, that's when you should talk to a professional and get some ideas of how to either improve your credit or to establish credit so that when you are ready to buy a home, you're in the best possible position to get the best possible loan product, rate, all that for you.
And how do they check that credit score? Do you have a best practice for that?
You can go to the freecreditreport.com. I think you can do that once a year and you can get the credit report there.
What mistakes do you commonly see first-time home buyers make?
First is waiting too long to get pre-approved. It can cause more stress than is necessary. Falling in love with a home before knowing your budget, that's another big one. So that's going back to the, talking to somebody first, knowing what you actually qualify for. Once you're under credit or under contract and you're locked in a loan, opening a new credit or buying a car or leaving your job, don't do any of those. Anything to do with money, talk to the lender first and not asking questions. If you don't understand something, ask. I hope that my clients feel that they can do that. Of course, you don't know everything. You're a first-time home buyer that, unless you're in the industry, you shouldn't know everything. And even if you Google it, most of the time it's probably going to give you the wrong answer, at least the wrong answer for you, right? The only person that's going to be able to help you understand what the best answer is somebody that knows your situation. Ask the question.
I was a little bit curious on refinancing.
Your lender should know your situation and have your best interests at heart. And so they should understand, obviously, where your current payment is, what a good payment reduction would be. And that's a conversation that they should have with you. You're like, I could save $100 a month. That's fantastic. If I could save $250, that's great. So some people have an amount in their head of what that payment would be. That and knowing which rate would actually correlate with that for your loan. So obviously, smaller interest rate improvements on a large loan are going to impact that bigger than if you have a small loan. They should have you on a watch list of okay, here's how much we're trying to save a month. That equates to about this much or this interest rate. Having them watch for that so that when it comes to that, they can start the conversation with you and be like, hey, we're here. What do you guys think? And other thing we look at when we're refinancing is, because there is a cost to refinancing. For us, it's about $3,000 in closing costs, depending on if you have to have another appraisal, things like that. So of course, if you're going to be paying for it, we want to make sure the monthly savings that you're getting with the cost that you're outputting, with the break-even point, isn't too far out in the future. So generally we do 12 to 18 months is what we look for as a break-even amount for that.
Pam, is there a good rule of thumb? I've heard if interest rates drop about 1%, you should at least look at it. You should be reaching out to your mortgage person, maybe talking about it.
If it dropped to 1%, I would say lots of people are probably in the boat to do it. Although not right now, because we still have tons of people that are in 3-4% rates from when they refinanced after the pandemic. So a 1% rate drop right now still only puts us in the low 5. It's really more of a looking at the payment savings. That's really where we want to dial in. Is how much per month are you going to save if we refinance?
What about how often can you refinance? Is it it's that same calculation each and every time, or do they not let you do it more than once a year? Or
for the buyer or the borrowers, you can refinance really kind of as often as you want, just knowing that there's a cost to it, whether that's rolled into your loan amount or you pay it out of your pocket. There's a cost to it. Now, that being said, like myself as a broker, we have what's called early payoff. If I refinance somebody, or say, we purchased last month and then they refinance within 6 months, I get highly penalized. Generally, these are meant to be long-term instruments. They're not meant to be paid off quickly because that's how the lenders and everybody makes money. And so if they're paid off too soon, they don't like that. So generally, we ask clients to try to hold on to at least 6 months if they can.
Pam, we were curious on the appraisal process and how a waiver works, and if that's something that you should actually do or if we should still get an appraisal even if it's waived.
First thing to understand is the difference between an appraisal and the inspection. The inspection is like the bones of the house. Like, are all the systems working? Is the foundation strong? Those things. But the appraisal is what's required by the lender, and the appraisal has to do with the value of the home. They want to know that the value of the home that they're lending on is there, because they don't want you purchasing a home and then the value being way less, them lending on a higher value. A lot of times when you have the requirement of an appraisal, or sometimes there can be what's called that waiver, like you mentioned. There's a myth out there that if you have 20% down that you're going to get a waiver. That's not necessarily the case. It does happen a lot, but it's really also if Fannie and Freddie have enough extra data on either that specific property or the areas around it, then they'll issue that waiver. And what a waiver means is that you don't have to get an appraisal because the purchase price that you have, they're accepting the value of the home at least at that purchase. Most of the time you'd want to just use that waiver and just use the purchase price. If you thought perhaps that you were overpaying for the home, then you may want to still get an appraisal. That way you have some other third-party proof to be able to negotiate with the seller. But generally, you'd want to just accept the waiver because most oftentimes that means the data is there to support the value and it is probably pretty darn accurate. And it saves you money, of course. Here in Colorado, a lot of the appraisals are anywhere from $650 to $850. So it saves you some good money. And then you don't risk the appraisal coming in lower by not doing it.
Pam, I think there's like first-time homebuyers incentives or some sort of special first-time homebuyer deals that they sort of get. Can you tell me about those?
So first-time homebuyer programs, really the purpose of them is to make buying a home more accessible, more affordable. The way they do that is by allowing for lower down payments, more flexible credit terms and guidelines, as well as lower mortgage insurance costs. First question is who qualifies for a first-time home as a first-time homebuyer? And it's not just if the first time you buy a home, it's if you have not owned a home or been on title for a home for the past 3 years, you are now a first-time homebuyer again. And so you can put as little as 3% down. And then those other things apply where, depending on the program, you may have lower PMI factors and things like that. The two biggest programs that get utilized by first-time home buyers, Home Ready and the Home Possible by Fannie and Freddie. Those ones, you actually don't have to be a first-time home buyer to use them. You can be a repeat buyer. The biggest difference with those is that they are income restricted. And so being a first-time home buyer, that means if you utilize those programs, you can put as little as 3% down. And I mean, in reality, most first-time home buyers, their income is lower. So a lot of the times they do qualify for one of those programs. And the income limit is 80% of AMI, which is the average median income of a county. So whatever county that the home is being purchased in, they look at the average median income, and you can only have 80% of that income as your income to qualify. And there's ways to get around that too. If we can qualify using only one borrower versus both borrowers' income, you can still utilize one of those programs. It really can have a big impact because it does often have a better interest rate, PMI. You can do as little 3% down. So those are good programs for first-time home buyers, as well as FHA is another one that can be utilized as well. And then there's down payment assistance programs. Now, those are not first-time home buyer specific, but a lot of times first-time home buyers may need to use them if they're having a hard time getting the down payment needed. But you have to be careful with that too, because sometimes there is a slightly higher rate to those. And a lot of times they do also have income limits on using those as well. So something we'd all look at for first-time home buyers to make sure we can, help them as much as possible. Lots of good things and opportunities for first-time home buyers for sure.
Well, thank you so much, Pam, for spending some time with us and just kind of going through this whole first-time home buyers process with us. Do you have any last words of wisdom or advice that you'd like to give to those first-time home buyers out there?
It's just such an exciting time. I know it's a lot of stress, And that's why it's really important to have a strong team of real estate agent and lender who work together well, are knowledgeable, and to lean on them, ask questions, do your due diligence as much as you can. Obviously, you're not going to know everything, but that's where the professionals come in. And so it's just going to make the process so much smoother.
Yeah, I love that. Well, thank you so much for sharing your expertise with us and being with us. I appreciate it.